For this week, we're going to be focusing on kind of following up on the training session that we had last week. We went over the different loan programs, different broker channels that we have. And so this week, I wanted to go over it a little bit more detailed in regards to our full doc. As I had mentioned previously, let me start recording, or not recording, sharing my screen. So within our full doc, let me see if our training, let me see. I don't see any. So let me just, so our full doc, which is also known as our QM loans, consist of conventional, FHA, VAs, and USDA.
Yes.
These are what we call full docs. Again, they're documents that we're using pay stubs, bank statements, not bank statements, sorry, pay stubs, tax returns, anything that is there that are being reported, the income is actually being reported to the tax with the IRS, where we can get verified with the tax transcripts. That's going to be our full doc. So today, want to go over. Eventually, we're going to go over all of them. So today, we're going to go over our conventional loans. So our conventional loan it has two different what we call, I guess, guidelines. Well, they're not too different. So we can go with Fannie Mae, which is what they call DU, or desktop underwriting, or we have our Freddie Mac, which is also is known as an LP. I think it's called Loan Prospect for this one. So these two are the different. You can look for the guidelines. They are slightly different, but overall they are the same guidelines. So I want to go over the different guidelines, or go over like the matrix, just so you kind of get an idea. Like I said, they're very similar, but they are slightly different. So anywhere where you see DU is because they're going based off of the Fannie Mae guidelines. Anything where you see the LP or LPA is going to be Freddie Mac guidelines. We can always just Google for their specific guidelines. So Freddie Mac and Fannie Mae. You can ask any questions and they will guide you based off of Fannie Mae's specific guidelines here. It'll tell you what to do. If you want to we can say we're trying to find, let me go back, overtime income. So now this is in regards to, it'll take you to that specific information that we're trying to find out. So it'll explain. So in this case, it's talking about the different income types. So our bonus or overtime, these are the documents that we need to obtain in order for us to be able to use that income. Okay. So it'll tell you like different information that we need if we're not sure whether we can use a specific income in regards to this. The Fannie Mae and Freddie Mac are where you need to go to find out the different guidelines. Okay. So for purchase and rate and term, as we've mentioned before, a rate and term is going to be refinance, where you're only changing a rate and term. You're not getting any cash back. The max you can get as a cash back for the bar will be $2,000 for it to not be considered a cash out refinance. So this conventional, it has the different LTVs depending on the unit. So for a primary home with the one unit, so a condo or a single family, if you're going to use the max LTV we can do is 97%. Being said, if it's a purchase, so they can put in a minimum of 3% down payment. If you're going to go with the LP, they need a minimum of 5% down payment. Now, if you're for that same single family, if you're trying to go with for a second home or an investment, that changes. So the LTV for a second home, whether it's LP or DU, they need a minimum of 10%. Versus previously, they can go a minimum of like 3% if we went DU. This matrix also gives us the minimum FICO. Usually for conventional, minimum FICO is going to be 620. For a lot of programs, the minimum FICO is going to be about 620. Depending on the lender, sometimes they have their own overlays and that will change. So if we're submitting this to a specific lender, we always want to verify what their specific matrix is. I am showing you the ones for UWM here, but this is usually the matrix. Let's see if this will. So Fannie Mae's website here, it talks about the DTI ratios, which are max DTIs. So the thing with these matrices, it's very, you can see things like, it's easier to find versus reading through the Fannie Mae guidance, right? For cash out refinances, they have their own different matrix, LTVs max as well. For example, if we're trying to do a cash out refinance on a second home for a duplex, we can't do that. You can do a two unit on a primary, cash out on a primary or an investment, but not on a second home. Okay. These are basic information as well. So we need, they have different programs like I think it's like Home Ready or Home Possible that are also conventional loans. They have this Fannie Mae lookup tool where you can look up the address. Well, you have to fill out the information, but you can find out the address and it'll give you the minimum, the AMI So if it's those specific programs, it means it's going to have different certain guidelines specifically on the income wise. There's certain income limits where you can't go over that income limit to qualify for those programs. This doesn't sit on here, but the DTI on a point file, right? So whenever we're working on a file, when we calculate the DTI, the debt to income ratio, the DTI for a conventional loan, it's max has to be under 50%. It can go up to 50. Again, this LTV based off of this matrix for DU, it's up to 97. If it's a manufactured home, it does change. So let me see where else I can find. So this right here says the max ratio is 36 front end and the 45 back end DTI. But give me a second. Sorry, someone just walked in. Never mind. Took care of it. But there's some cases where it does allow you up to 50%. Okay. So this DTI, debt to income ratio, the way it's calculated, I'm not sure if we've previously kind of went over that or not, but the way it's calculated is that it's going to include your income and your liabilities. So the total amount, let me go here. So it'll be the proposed plus whatever liabilities you have. And then if you divide the liabilities to the income, it's going to give you your ratio. So this debt DTI or debt to income ratio is just verifying that you have enough income to sustain the debt that you're going to be paying. In this case, which would be your mortgage plus any other credit cards. Does that make sense?
Yes, and that includes as well the mortgage insurance, the property county taxes.
Yes, so as you can see right here, your primary expenses is going to be this one right here, your total. So it's going to be your mortgage for principal and interest, insurance, property taxes, mortgage insurance, any HOAs if it's applicable, plus your total obligations for your credit cards. In this case, it's showing 888. When you add these two, you're going to get the 6,934. So you're going to divide this 6,900, 6,934.62, divide that by your income, which based on the calculation we have here, 16,666. And so your ratio is 0.41, and it's going to be a percentage. So it's going to be 41.608%.
That's good.
Our LTV is going to be your loan to value. So in this case, it's going to be your loan amount
divided by the property.
Divided by the appraisal value. Correct. That's going to give you this percentage. So if we're doing an investment on a 2-unit, right, our LTV has to be 75. This case, because our LTV is at 79, we would not be able to work this file either. We need to increase the value to get this under 75 or lower the loan amount to get this under 75. So if we're increasing, we always want to do a value check so that way we can correct. So we can make sure that we are able to get that value. What else?
What if we're not, we just retain the LTV and then we are not going to reduce the loan amount? We will just put some cash on it. Will that work as well?
For a refinance?
No,
like bring in money?
I think that works for purchase. I don't know.
Yeah.
For finance, it's a different.
So when they can bring in money. I'm not too sure if bringing in the money would help the LTV though. But yeah, for example, if they're trying to pay off certain accounts to get RTTI to work, but we still want to keep it as a written term, yes, they're able to do that. Okay. We have I'm going to talk about our next. Oh, before I move forward, for conventional, if our LTV is over 80%, in this case, as our matrix, like for example, of a purchase, if it were using 97%, we have to include our mortgage insurance. So I don't know if it was with you that I did this training, but if you order a quote for MI, we just complete this question, the information here. It's a PUD primary. I'm just putting in information here just to get this quote so you can see. You do have to select whether they're self-employed or not, or else it won't let you go proceed. So then once you input that information, it'll issue this quote. So then that's what you would put under your mortgage insurance. You would just put 0.51. Okay. This mortgage insurance, again, it's for this one right here is for conventional quotes only that are when your LTV is over 80%. So the MI, we always have to put it in our refinances and our purchase. So for example, if we're doing for the refinance or written term refinance on a investment property, because it's under 80%, we don't have to worry about including MI. But all these other ones that are 85 and higher, we have to include the MI. Okay. When we are doing this the point file for a refinance, if it's a rate and term, you're going to click this limited cash out. Limited cash out, rate and term, it means the same thing. Whether it's a conventional loan or an FHA loan, whatever it is. Limited cash out is going to be your rate and term. We have our FHA as well. The FHA guidelines are a little bit different than conventional. We don't use Fannie Mae and Freddie Mac as we do. They have their own PUD guidelines. for FHA, you would use this housing handbook. If you have any questions, you can like Google and then it'll find you that information. They use this handbook here for FHA guideline information. So on the FHA, we are always going to include the upfront mortgage insurance, and we're going to include the monthly mortgage insurance. So for FHA mortgage insurance, I have this one saved here, but if you can probably Google it and find it. So depending on the loan amount and the LTV is what the rate is going to be. So for any loan amount that is 726,200 or lower with 95 LTV, your rate is going to be 0.55. If it's anything over the 726,200 and the LTV is over 95 as well, then your rate is going to be 0.75. Does that make sense?
Rate for the mortgage insurance?
For the mortgage insurance, correct. So you know how earlier I put 0.55 because that was what the quote gave me?
Yep.
So in this case, training purposes, let's say the LTV is 97 and this is our loan amount. Because this 766 is over this number and our LTV is at 97, then our rate here, we have to put 0.75. Our upfront mortgage insurance, you're going to click, well, first, if this file was an FHA, we have to make sure this is checked off as FHA. And our mortgage insurance here, we're always going to collect 1.75% upfront, okay? Because this has sense, we're just going to put 0.54 here to make it even. So FHA, we're including upfront mortgage insurance and our monthly mortgage insurance, okay? The main difference is that for their, whether it's a 1, 2, 3, or 4 units, LTVs stay the same. They don't change versus like conventional, depending on how many units the property was, it changed. So this, whether it's, so on a purchase, the LTV you can do is 96.5, meaning you can do a 3.5% down payment.
That's for purchase.
Yes. A rate and term, it can go up to 97.75. And for a cash out refi, it can go up to 80%. Again, main difference here is that the main FICO, the minimum FICO on FHAs can go up as low as 580. We do run our AUS, but again, they go based off of the HUD guidelines. We don't go with Freddie Mac or Fannie Mae. We go with the HUD guidelines. What else? FHA refinances, they have the streamline is, let's say like a faster way for refinance to go because it's already approved as an FHA. Then there's no need to
Other term for that is
they don't include income. I'm sorry?
Other term for streamline is faster finance.
It's supposed to be a faster refinance. It's supposed to be a bit easier because they don't necessarily require an appraisal report or income documents. It's supposed to be a quick, faster way to get the refinance. What else? Trying to think. For FHA purchases, it always has to be, the FHA is a primary, primary only. You can't do, or any even refinances, you can't do investments or second homes. If you're going to have your loan be a mortgage, you have to do it as your primary home. Do you have any questions?
Nope.
Each lender has their own, like I said, has a quick little own matrix. For example, let's say if we go with NMSI here, if you go product matrix, we have our conforming DU and our conforming LP. That's going to be your conventional loan. They have right here Fannie Mae and Freddie Mac as well, right? FHA guidelines, you have different FHAs. So we can click on it and it'll give you the quick guideline. This one in this FHA, because I'm assuming it's an overlay guideline, at their minimum FICO that they're willing to do is 620. So like I said, each lender has their own overlays sometimes. So even though it's standard, let's say conventional 620 and FHA can go down to 580, we always want to verify with that lender if they're willing to take that, because each lender might have their own guideline that they would go based off of. So if you ever, again, if you have any questions, you can always go back to the lender page and you can see our FHA full doc. These are our full doc lenders. So any conventional or FHA or VA or USDA, we can go with these lenders. If you have any questions in those particular, you can always reach out to them directly. Any questions?
Hold on. I think